Welcome to W4.0. My name is John, and with me is Neil Woodford. Neil, this week has been dominated by some surprising economic data, but we've also seen an AI company that's run into some headwinds, and there's been a sort of ongoing reshaping of the UK's energy sector. I'm going to ask you to try and help us understand what these mean, but I also would like us to focus on what we need to watch next week. Just a reminder, everything in this show is for information purposes only. None of this should be treated as financial advice. But with that said, Neil, let's start with the UK economy. We saw this week that GDP grew by 0.3% in the second quarter, and that beat the consensus forecast of 0.1%. This is something that you were saying you've been talking about for some time, but it's left a lot of people confused. What's really going on here?
Well, I think once again, this data release sort of shines a light on what I believe is an overwhelmingly negative consensus view about the UK economy.
Today's numbers show that the economy beat expectations in the second quarter of this year. We are the fastest growing economy in the G7 for the first half of this year, with a GDP growth of 0.3% this quarter, and that's after GDP growth of 0.7% the quarter before that. Some
interesting ways to look at this data. First of all, maybe surprisingly to some listeners, the just over 1% growth rate that implies for the UK economy in the first half of the year means that the UK economy is in that period the fastest growing G7 economy, so faster than the US, which is growing at 0.6%, and faster than the EU economy, which is growing at 0.7%.
That's not something you hear anyone talking about.
No, nobody will mention that, or at least mention it and then admit that they were wrong about how gloomy the outlook for the UK economy is. But I think there's a sort of slightly more interesting sort of piece of analysis that can be done on the data. What GDP data quarter by quarter is naturally volatile, but if you average out the UK economy over the long term, broadly, we grow at about 2% per annum over the long term, just over 2%, which means that on average, we grow at about 0.5% per quarter. Well, the average of 0.7 and 0.3 is 0.5 per quarter. The economy appears to be growing at about its long-term average rate of growth at 0.5 per quarter. And that's despite the first half of the year that's seen significant tax increases, a pickup in inflation, and a very sort of cautious MPC only cut rates very slowly. To my mind, that's a pretty good and robust performance against a backdrop of an overwhelmingly negative consensus. And as I've said, higher taxes and a slightly less good labour market, slightly rising unemployment, which I talked about recently. So the UK is actually doing okay. I mean, it's not shooting the lights out by any means, and I would never suggest that. We're challenged by many, many things, but the economy is not in the hole that everybody seems to believe. And I think this data bears that out. Now, importantly, this week, we've also seen a very gloomy, doom-laden, I described it as, outlook from the National Institute of Economic and Social Research, which has suggested that as a result of, well, they've said the headline suggestion is that we've got a £50 billion hole in a fiscal hole in the budget, and we need to fill that with extra taxes. Now, I completely disagree with the Institute's forecast. It's based on a very, very gloomy view of the long-term growth of the UK economy between now and the end of this decade. And when you look at what they're advocating and what they're forecasting, their growth expectation is just over 1% per annum, slightly over 1% per annum on average over the forecasting period to the end of the decade. Now, as I've just highlighted, that's half the rate of growth that the UK has averaged over the long term, and certainly half the rate it's averaged in the first 6 months of this year. And there is no explanation in the National Institute's analysis that suggests or points to the structural problem in the UK economy that explains why growth will be so low. So I think this is an important point, again, and it highlights what I'm saying, which is the economy is challenged, but it isn't as bad as people think. And we should all be a little bit more optimistic than we're told to be by the media.
I guess the danger is you end up with policy decisions being made against perhaps misleading or inappropriate forecasts. Is that the danger you're worrying about?
Yeah, exactly. I'm very worried that policy decisions today are going to be based on forecasts from institutions like the National Institute, for example, or the OBR, that are based on all sorts of variables that, frankly, they frequently get wrong. I think we need to stop being so led by forecasts and focus a bit more on what's actually going on in the economy contemporaneously. I think the Bank of England appear now to be doing that. So, for example, we've had 5 interest rate cuts whilst inflation has been rising. That, to me, is an encouraging sign that the MPC is relying less on its model and thinking more about what's actually going on in the economy. And that was something that Ben Bernanke recommended they do, and it appears to be what's happening. The next piece is that I think the government needs to speak to the OBR and say, yeah, we understand what your forecasts are going to be, or the National Institute. We understand that these are forecasts, but we are not going to base policy today on what you think will happen over the next 5 years, because your forecasting record, frankly, is not good enough for us to do that. We need to base our decisions on what's happening today.
And is there anything that, with people listening to this, is there anything that we can do to either, I don't know, take advantage of the situation or to help correct the ship?
You know, I suppose we all make a difference in a weird sense. My message to people listening, and indeed a broader message to those who won't be listening, but who might read my stuff or who might be worried about the sort of overwhelmingly negative media consensus view, is just put your fingers in your ears. Don't read that stuff. Don't be dragged down by the chip wrap that we spend too long obsessing about. The underlying economic performance of the UK economy is nowhere near as bad as we're being told, and that should be reassuring. Should be reassuring for households and reassuring for businesses.
Now, across the Atlantic, US CPI data came in softer than expected, and there is ever louder talk of rate cuts over there. The market seems to be baking that move in September. What's your take on the US situation?
Yeah, once again, I think there's a really interesting sort of comparison between a sort of crowded consensus view and the reality. As everybody will know, the crowded consensus view was, well, you know, tariffs are going to drive up goods price inflation. Higher goods price inflation will create a major headache for the Fed. It'll produce higher headline inflation. The Fed won't be able to cut interest rates. They're under a lot of political pressure from Trump's administration to cut. This places the organization in a very difficult place. But ultimately, the view was tariffs equals much higher inflation. Now, the reality is that that's not happened.
I think we saw the Fed Chair Jerome Powell talking. He didn't actually say they got that wrong, but it just that goods prices weren't increasing as quickly as they'd expected. That's got to be a relief for markets.
It is. I think it is a relief. And I think that inflation number did have an impact on markets globally. I mean, I think the bond market's a little bit better, but equity markets everywhere had a pretty good day on the back of that. It's really important. But once again, the consensus view that tariffs equals higher goods price inflation was just a lazy sort of academic economist view, rather than the product of analysis embedded in economy. Everybody, I said at the time back in April, the headline tariff rates are not going to be anywhere near the sort of the headline numbers that were published on Liberation Day. I said that the idea that this would automatically create high headline goods price inflation was wrong. That companies operate in competitive markets and they will be very focused on maintaining or growing market share. A lazy consensus view that because a tariff had gone up 10 or 15 or 20%, that would mean that whatever they'd imported from whatever part of the world would be 20% more expensive, was just, I think, silly. And that appears to be what's happened.
I wanted to touch on something that you mentioned to me earlier, and it's something that's been getting less attention than it probably should, which is the drop in oil prices, especially when you look at them in sterling terms. Just in summary, Brent crude has been sliding in dollar terms, but with the sort of relative strength of the pound, the picture looks quite different for UK consumers and businesses. How much of what we're seeing is down to currency rather than the oil market itself, and what might it mean?
I think it's a bit of both. I don't think it's all currency. Certainly the oil market is well supplied. OPEC is trying to constrain output to sort of manage the price, as they always have done. I'm not somebody who spends too long on looking at individual countries' output versus quota, or looking at what's going on in the US market. But it's clear that the oil market is well supplied. The global economy, albeit that forecasts for global growth have gone up recently, the fact is that energy consumption is not as strong as some might have forecast a few years ago. Anyway, the long and the short of it is that with Iranian and Russian oil basically to some extent on the sidelines, there is always a potential for the oil price to be considerably weaker in a less stretched or a less sort of tense geopolitical world. Anyway, the long and the short of it is the oil price has been coming off, but because sterling has strengthened against the dollar's been generally weaker against global currencies. The oil price, in fact, is down nearly 30% in sterling terms from the peak in January this year. So that's important from the inflation perspective in the UK economy. We know the food price inflation has picked up a bit recently, and we know that administered inflation has picked up. But when I look at the sort of long-term path for inflation, the fact that energy prices are going down and considerably lower than they were at the start of the year gives me encouragement that the outlook for inflation is actually better than people think.
And are there particular parts of the economy that benefit most from that? How should people be thinking about this?
I think there will be a broad benefit, because I think the inflation, the relatively high inflation rate that we're seeing at the moment declines in the way that I think it will over the remainder of this year and on into 2026, that will mean that we will get lower interest rates, significantly lower interest rates in the UK, and that's going to benefit everybody. Of course, I think the most significant benefit is that lower interest rates will rebalance the economy, and particularly the household sector, where deposit saving effectively is well above normal. So people are saving because they're getting good income on their deposits. As interest rates fall, that rate of return on deposits will decline, and I think that will lead to lower growth in saving, or lower deposit growth will also result in higher loan growth. And I think that's what we need to rebalance. The relationship between loan growth and deposit growth needs to be rebalanced, and that rebalancing will come from lower rates. And that, I think, will be the thing that will drive higher rates of consumption growth going forward.
So moving over to technology, we saw in the news this week that the Chinese AI company DeepSeek has hit some problems with its newest model, R2. And for anyone not following that story, DeepSeek is a Chinese AI startup. And it made a name for itself over the last couple of years by rapidly scaling and delivering a large language model that is comparable with those by Anthropic and OpenAI. And it's really positioned itself as a sort of a symbol of China's push for self-sufficiency in AI. And that's why the setbacks for R2 are sort of raising some eyebrows. What's your read on the challenges that they're facing and what it could mean for China's AI infrastructure?
Yeah, I think this is an interesting story, which there hasn't been too much attention paid to this week. Now, let me preface what I'm going to say with, I'm not underestimating the ability of China's technology industry to overcome the challenges that they currently confront. But it is clear that DeepSeek is confronting a challenge, and that challenge really it relates to the fact that it has been encouraged and has had to rely on Huawei chips.
As I understand it, the process of training the model ended up being a lot more difficult than had they been using NVIDIA's chips.
Yeah, I mean, basically they were using Huawei chips for training and inference, and it appears as if the training part of that requirement just wasn't working out. So the chips weren't performing as they should have been, and I think there was a software problem. I think the chips weren't communicating or connecting with each other appropriately. And what that has meant is that DeepSeek have delayed the release of R2 and have had to revert back to using NVIDIA chips for training, and it's using Huawei chips for the inference piece. But this just shines a light, I think, on the challenges that all AI developers confront. It's not easy to develop these highly sophisticated models. And what I think it also highlights is that there is a clear lead in chip technology in the US over China at the moment. And I think it's going to be very important to the US economy and to US strategic interests to maintain that lead.
Moving on to the energy sector, and we saw this week that Harbour Energy has decided to stop investing in UK North Sea, blaming the windfall tax and the wider fiscal environment.
Harbour Energy, which may well not be a company at the forefront of people's minds, but it is the UK's largest oil and gas company operated domestically. Basically, this week, it has announced that it is no longer going to invest in the UK North Sea because it confronts a ridiculously high tax rate. Now, UK operations for oil companies are naturally higher cost than other locations. But when you layer on top of high cost operations a very high tax rate, it's just become uneconomic for Harbour Energy to invest in the UK North Sea. Now, already it's announced, I think, 250 odd redundancies in Aberdeen, and the investment that it was going to put into the North Sea, in the UK North Sea, is now going to go into places like Norway, which operates, frankly, in the same bit of water in the North Sea, and in places like Argentina and possibly Mexico. Now, I just think this once again highlights the problem confronting the UK's energy policy. And indeed, I think it's another example of the Laffer curve kicking in. So windfall taxes on North Sea production were introduced by the Tory government, and the Labour government extended the windfall tax to 2030. As a result of that, unbelievably, as a result of providing for deferred tax, Harbour Energy confronts a 111% tax rate on its North Sea operations. So it makes sense for them to not invest. Now, as a result of that, of course, the tax take from companies operating in the North Sea is falling. Indeed, it's fallen significantly. So once again, the Laffer curve kicks in. It doesn't just present itself in capital gains tax or stamp duty land tax. It also occurs in the corporate sector. If you tax companies too highly, they'll move their operations and go and operate somewhere else in the world where they can make a higher return.
And for those people who may not have seen the blog post where we explained the Laffer curve, the idea is that, or the theory is that as you increase tax rates, you increase tax revenue until you hit a tipping point. And if you continue increasing tax rates past that tipping point, you actually reduce tax revenue. And that's what you think we're seeing here.
It is indeed what we're seeing here. Yeah. So the theory is based on this idea that at 0% tax, you get zero revenue. At 100% tax, you get zero revenue. And there's a sort of relationship between tax rates and tax revenue that describes a sort of U shape, but the precise relationship between those two things is never, it's not knowable, frankly, ahead of time. But you can impute a sort of a tipping point. You can guess where that tipping point might be, and we've certainly reached that tipping point, as I've highlighted, in stamp duty land tax in the UK, with respect to capital gains tax in the UK, and we're seeing it now with respect to the tax take from windfall taxes levied on oil and gas operations in the North Sea.
And I guess that the number of people that you see leaving the UK, we've seen that headline countless times, the number of ultra wealthy people leaving the UK is on the rise. That's probably a symptom of the Laffer curve in action, I guess.
It is. Yeah, it is too. Yeah. The non-dom issue, wealthy people deciding to up sticks and go and live somewhere else in the world. There are plenty of alternatives. That is a potentially big problem for the UK, because it's become, tax revenue is very dependent on a relatively small number of relatively wealthy people paying a huge percentage of, for example, income tax.
Now, staying in the energy sector, this was a statistic that really made me raise my eyebrows earlier this week. UK wind farms reportedly being paid not to produce electricity nearly 40% of the time. How on earth does that make sense?
Well, once again, I've just touched on one aspect of the UK's crazy energy policy, which is, the very, very high tax rates on oil and gas producers in the North Sea. Well, the other aspect of this sort of crazy energy policy is this sort of mad dash to net zero. What that means is that there are huge incentives available for wind farm developers. Wind farm developers want to capture those incentives. And so lots of wind farms have been built. But the grid infrastructure that connects relatively remote wind farms off, for example, offshore northern Scotland, for example, there isn't the grid capacity to connect those wind farms to the grid such that the electricity that those wind farms produce can be used in industry or by by consumers.
So this is an example where you can build generation more quickly than you can build infrastructural capacity or storage.
I mean, we've just created a series of sort of discontinuous incentives. We haven't built grid infrastructure in parallel with renewable generation, certainly in offshore wind. And as a result of that, we're paying, I don't think it related to all offshore wind farms, but certainly to a number of very large offshore wind farms off the northern coast of Scotland. Those wind farms were paid in the first 6 months of this year not to produce 40% of the time. Now, this speaks to the craziness of the UK's energy policy and its mad pursuit of net zero on an impossible timescale. It just layers cost on cost on cost, and it is one of the reasons that we've got the highest industrial electricity prices in the world and amongst the highest household electricity prices in the world. It's a huge disincentive for industry, and as a result, it's putting people off coming to the UK or investing in UK industry. I read this week, for example, that INEOS are, I think, apparently going to close a big chemical plant in the northeast purely and simply because of the ridiculously high cost of energy that they face in the UK. It's one of the last remaining significant chemical plants in the UK. And there'll, of course, be redundancies as a result of that. And, of course, we will have to still import the chemicals that were produced domestically. We'll have to import those chemicals in the future from producers in other countries. So, look, the policy's mad. It's producing all sorts of the wrong incentives, like paying wind farms not to produce energy or driving the largest oil and gas company in the UK not to invest in the UK. All of these, or driving a chemical producer out of the country, all of these things are a direct product of our mad energy policy, and we need to change direction soon.
And looking ahead to next week, there's a few things on the radar, I guess, to watch out for. Wednesday next week, UK and EU inflation data. Why is that important?
Yeah. Well, inflation data is always important. I think, maybe we attach too much importance to the sort of the volatility we get month to month. But I think the general sort of consensus view is inflation will remain high, and it might even go higher in the short term as a result of the administered price increases that we've seen in terms of gas, electricity, water, and the only really inflating item that isn't administered is food price inflation. All of those things have contributed to a pickup in inflation that we've seen in recent months. The expectation is inflation will rise again. I'm not so confident, but I'm less obsessed about what we think or what the near-term inflation numbers will be, albeit that the media will obsess about them. I'm more interested in what I think are the drivers in the medium and long term that will I think push inflation back to the 2% target that the Bank of England has. And importantly, those things are lower energy prices, which will ultimately result in lower food prices, base effects. So we won't again see the big increases in gas, electricity, and water that we've seen recently. So that's an important factor to bear in mind that will influence future inflation. The other impact that will drive inflation down is lower wage settlements. So I think a combination of lower energy prices ultimately leading to lower food price inflation and heat coming out of the labour market will, I think, give me confidence that the medium-term outlook for inflation is encouraging.
We've also got UK retail sales data on Friday.
I think, in a way, it's a sort of a proxy for consumer confidence to some extent. It's always heavily influenced by weather. Obviously, we've had a fantastic summer in the UK. The weather's been brilliant. So people will look at retail sales and and impute some sort of measure for consumer confidence. It'll be interesting to see what the outturn is. I'm not going to call 1 month to 1 month, but there will be a debate about how consumers are thinking about the current environment. I think low interest rates obviously help consumer confidence. That's important. We've seen a cut recently. I think we'll see another one in November. That's going to help confidence going forward. Interestingly, the housing market is showing some signs of life. Mortgage lending is picking up a bit. Transactions are picking up a bit. So, the news is beginning to get better. And so, I think retail sales may reflect that.
And lastly, we've got US labour market data on Thursday.
Yeah, labour market data is really important. Just as in the UK, the US labour market has been easing recently. This was, again, something that the Fed were a little bit worried about and focused on. along with tariffs. It's quite clear that the US labour market has eased up recently, and I think this will give the Fed more encouragement in September to cut rates, basically. So it will be an important data release. The jobless number on Friday will be an important data release. And I think it will confirm what the Fed has been thinking about and saying, which is, the probability of a cut of a cut in rates in September has gone up significantly. And I think this data series would have to be very strong to sort of derail that sort of trajectory to lower rates in September.
Well, Neil, I think that's all for this week. Obviously, we'll keep watching how the data, the markets and the companies discussed today evolve, and we'll be back next week. Next week, we have also got the members-only Q&A for W4.0 members. So if you are a W4.0 member and you haven't yet registered for that Q&A or asked a question, please make sure you get your question in, and we look forward to answering those next week. Hopefully you found this useful. If you have questions for Neil, I doubt anyone's got questions for me, but if you have questions for Neil, please do send them across using the hello@w4pz.com email address. Look forward to speaking to you next time. Thank you.